got some great information for you that I think that you will find very useful if you are interested in real estate investing. Today's topic, all about money. That's the whole reason we get into real estate investing, right? We want to see great returns on our investments. That way we can make our financial dreams come true. Calculating your return on investment can be daunting if you've never done it before, but it's important that you know how to do it. That way that you can plan for the future and be successful in your goals. So let's dive right in so I can help you understand. So let's start with a couple numbers that you'll need in order to get your final ROI numbers. The first one is net operating income. To get this number, you take your gross monthly income, which is your monthly rent times 12 minus your vacancy rate, and then you subtract your total operating expenses. Operating expenses are going to include things like property management fees, taxes, insurance, maintenance, etc. So once you get your net operating income, you want to take that number and you want to use it to get your cash flow. Your cash flow is your monthly income received after all of your expenses and mortgage are paid. To get your cash flow, you take your net operating income and you subtract out your monthly interest and principal payments. So now that you know how to calculate your net operating income and your cash flow, let's calculate out your ROI. There are 4 very important calculations that you'll want to know in order to successfully and strategically grow your portfolio. Number 1 is ROI from rent income. Number 2 is ROI with depreciation. Number 3, ROI with appreciation. And number 4 is ROI with the tenant paying down your mortgage. Okay, so let's first cover number 1, which is the cash on cash return on investment from rent income. To get this number, you take your annual cash flow, which in this example we're going to say is $3,000, and you divide that by your total cash investments, and that will include your down payment and your closing costs if financed. And let's say in this example your total cash investments were $28,000. This will give you an ROI of 10.7% from rent income on the first year. Let's now calculate ROI with depreciation. So in this example, let's say the home is $125,000. If this is a residential home with 4 or less doors, you always divide it by 27.5 years. So $125,000 divided by 27.5 gives you $4,545. You then take that number and divide it by the tax bracket that the investor is in. And let's say in this example is 28%, giving you $1,272. You then divide that $1,272 by your total cash investments, which was $28,000, totaling a 4.54% return on investment with depreciation in the first year. Okay, let's calculate return on investment with appreciation. To calculate ROI with appreciation, you want to take the purchase price of the home, which was $125,000, and add the amount of appreciation that you had in the first year. And let's say in this example, that's 5%. This will make the market value of your home worth $131,250 after year 1. You then want to subtract out what you purchased the property for, which was $125,000, leaving you with $6,250 worth of equity in your home after the first year. You then take that number and divide it by your total cash investment, which was $28,000, leaving you with 22.32% ROI with appreciation after the first year. And finally, let's calculate ROI with tenant paydown. To get this number, you take the amount of principal that you paid down in the first year, and in order to get that number, you can get online and just look up an amortization schedule and see how much principal you paid in year 1. But in this case, let's say that the tenant paid down $3,000 worth of your principal. You take $3,000 and divide it by your total cash investments, which again is $28,000, totaling 10.71% ROI with tenant paydown in year 1. Taking all of these returns and calculations into consideration, you could have around $10,000 to $14,000 in equity just after year 1. So just imagine after 5 years, you could have around $40,000 in equity. You could then tap into a 1031 exchange, sell the home, invest in more properties, allowing you to grow and diversify your portfolio. I believe that educating yourself properly on how to calculate your return on investment is the first most important step in real estate investing. When building a portfolio, you need to plan ahead and fully understand each step of the process to successfully reach your financial goals. I hope that by watching this video today has done just that for you. Thanks again for clicking on the link and learning a little bit with us today. Don't forget to hit like and subscribe, and we'll see you next time.